Okay, so besides price to earnings, the second and third most popular metrics are price to book and price to sales. I'll be honest, I seldom use them. I don't explain why, but they're common enough that you should know what they are, how to find them, and how to use them. Let's talk about price to book first. So here's an example right here. These are all pretty easy to find on most financial websites. Your broker has one. Really, you can get them all over the place. Price to book value is simply price over book value. If you want to be hardcore, you could take a 2-period average, end of year and beginning of year book value. If you want to be like really hardcore, and if you are, you probably don't have any friends, you could take a 4-period book value, all the quarterly book value statements, and average that out. I don't usually bother because I don't bother with price to book in the first place, but just know that some people do. Why don't I bother with price to book? Let's talk about that. It's got some weaknesses. First of all, like we talked about before, accountants like historical costs. And that preference distorts accounting statements. The brand values of great brands like Coca-Cola do not appear in book value. So book value is just pretty far detached from whatever the real value is for those companies, except for financial firms because of mark-to-market accounting. Mark-to-market accounting relies on external market prices to impute the correct, if you will, book value of financial firms, which use mark-to-market accounting. So for financial firms, it is a reasonable proxy. For all of the firms, it's really not so good. Now, let's move along to price to sales. We're going from bad to worse. Okay, I don't like price to book very much. I really dislike price to sales. But before we get into why that is, just take a look at what it is. Price divided by sales. So for every single company, you can compute price to sales. And again, you can get it on basically any website. Okay, just about 30 for this company here. Here's why I don't like it. It's a desperation multiple. I say that because you use it when you're desperate. You don't have anything else. Company doesn't have positive net income. Well, what about operating income? Doesn't have positive operating income. What if we add back depreciation and amortization and use something called EBITDA? Doesn't have positive EBITDA either. Well, it's losing so much money, we just have to use sales. And that's how it starts. Basically, you don't have a lot of good quality information in price to sales. That's one problem. Okay, another problem is it doesn't adjust for different debt ratios. Remember, price is an equity number. Sales is available to both debt and equity holders as those numbers trickle down the income statement. So a company could take on a whole bunch of debt and look a lot better on a price to sales metric than a company that doesn't have as much debt. But it may not necessarily be a better business. It just might be a riskier business. And just overall, metrics have the problem of not delivering a lot of information, and price to sales has that problem magnified. So you will still see it for like SaaS companies these days or early stage companies that just don't have any other way to compare. You'll see price to sales, but my advice to you is only use it when you have to. So if you do use multiples, you want to compare them 2 different ways. One way is across the company's own time horizon. So in this case, we've got blue, which is price to earnings. We've got red, which is price to book, again for multi, and we've got green, which is price to sales. In this case, even though I kind of hate these 2 metrics, they're confirming the same trend, that this stock is getting more expensive over time. We're starting in 2012, and then here we are almost 10 years later as we're filming this. Price to earnings in particular has gone way up. So comparing across time is one way, and the other way is comparing across a company's peers and see how they look. Now, in this case, our guy is in blue, so it's not so bad, maybe on the slightly more expensive end of the spectrum. But again, valuation is meaningless unless you have something to compare it to. All right, so thinking of multiples, big picture. What are the problems? Well, we know the good things first. Let's talk about the good things first. I always say the good first, right? Multiples are quick. They're easy to use, they're easy to understand, and they're available basically everywhere. So you can't not use multiples. I use multiples all the time. But you also can't not be aware of the weaknesses? First thing is because you're really just using a few numbers. They're vulnerable to being thrown off by one-time events. If a company had a bad year of earnings one year that's not representative of its ongoing earnings capacity, its PE will look very poor. Now, luckily, the market is generally smart enough to notice that, but it's still a factor. Another thing is cycles. Businesses move in cycles, so multiples don't represent or don't capture that cyclicality, with the exception of the Shiller PE, because it deliberately uses 10 years of data. But except for that, they don't. Another thing is they're computed using historical data. And remember, as equity investors, we're buying the future of the company, not the past. But guess what? The future data doesn't really exist, so we just have to use historical data. So there are plenty of concerns about multiples, but they're just so common that I guarantee you're going to use them a lot anyway. Now let's get to discounted cash flow valuation. This is like the real way that professional investors value companies. This is what I've done for many, many years, both at a hedge fund and then when I was doing advisory work here in the US. I did a lot of DCF valuations. It is more work, but it's also more accurate. And it basically ties into the concept of present value. Let's talk about present value. I'm going to ask you a question, an obvious question. Would you rather have 100 RMB from me now or my promise of 100 and something RMB from me in a year? Now, obviously, I've got to promise you more than $100 for you to even consider that. Question is, how much more? Well, you think about that. And if you were like most market participants, eventually you would decide that you need to bake two concepts into answering how much more. One is opportunity cost. What else could you be doing with that money during the year that you're waiting for me to make good on my promise? The second thing is risk. I'm kind of sketchy, right? Like, what if I don't give you the money? What if something happens to me, right? You know, what if somebody kills me? Oh, hopefully not. But like, bad things could happen that impair my ability to fulfill that promise. So what would your answer be? 110 RMB? 115? 120? 150? Okay, whatever it is, that number basically equates to a discount rate. And whether you say promise or amount expected, we're basically saying that you, or at least an investor, would be indifferent between getting a real 100 RMB from me now and my promise of, for example, 120 in the future. So in other words, the present value of an expected 120 RMB from James Early in 1 year is worth 100 RMB now. That is the core of all finance, and it's definitely the core of discounted cash flow valuation. But let's think specifically, right? How would we think about this? Well, higher risk means higher discount rate. That's for sure, right? The riskier the person, the more, or the riskier the company, the more you'd want. There are many scientific, or I'm going to say pseudo-scientific, like semi-scientific methods for computing the discount rate. The capital asset pricing model is one of them, CAPN. There are many others. One way to think about it, though, well, and by the way, I don't generally use them because the academic evidence is not particularly supportive. You know, it feels good as people to do a bunch of math and get a precise number, especially in investing where there's a lot of ambiguity, because the numbers, the precision, feels like it protects us, right? Oh, I did a bunch of math and I got a real number, but it's usually an illusion of precision. It's not real precision. Real precision does not exist in a social science. I'm sorry to tell you that. It just doesn't. So what can we do instead? Well, one idea, what I do, is look, for example, at the S&P 500 and say, all right, if it's performed about 9% on average over its historical life for a stock that I would consider to be about as risky as an S&P 500 stock, I'd use about a 9% discount rate. Simple enough, right? What you expect. Now, for a risky stock, you might go all the way up to 15% for a particularly safe stock, like a water or a sewage company. I mean, No one's going to stop flushing their toilet in a recession, right? You might use 7%. But again, these are just rough guidelines. Your mileage may vary, and the art of choosing a discount rate affects how good of an investor you become. All right, so once you have your discount rates, what do? Well, you got to discount something. So here's the whole process for valuing a company using DCF. First thing you do is you predict the future cash flows of that company. The future earnings, future cash flows, whatever, we'll get into that later. Then you get your discount rate. Then you discount those cash flows just the same way that 120 RMB promised by me might be only worth 100 right now. Same thing for a company. You predict what they're going to do in the future and you decide what it's worth now. Then you add any extra cash the company has. You subtract out any extra debt, sometimes make some other adjustments for things like stock options, deferred taxes. We're not going to get into the complicated stuff here, but there's some minor stuff. And then you divide by number of shares, and you'll get a result. And if that result is, let's say, meaningfully better or above the current stock price, you would decide, if you believed in your valuation, that the stock is underpriced and you would buy it. As simple as that. All right, let's get to the first formula. Now, remember that 120 versus 100. This is kind of the same idea. Let's say that you have 100 RMB expected in a year with a 12% discount rate this time. Here's the formula. You'd stick that future value in right here, and you divide it by 1 plus the discount rate to the exponent of number of years. And in this case, 100 RMB promised a year from now or expected a year from now from a company divided by 1.12, 1 plus discount rate to the first power, which doesn't do anything, it's just 1, equals 89 RMB today. In other words, if you believe in this 12% rate, you would basically be indifferent between 89 now and 100 a year from now for this particular company. So let's get a little bit more complicated. What if this comes 9 years out instead of 1 year out? Formula looks almost the same, except you swap in 9 for the exponent instead of 1. And it makes a big difference in the math. You're down to 36 RMB instead of 89 because that 100 RMB is being expected 9 years out instead of just 1 year out. And that's the power of compounding at 12% interest. Now let's make it a little more exciting and add 2 cash flows. We're building up to a normal company situation because very few companies pay literally just 1 cash flow and then disappear. So let's say this company is going to have 100 RMB expected in a year. Then the year after that, expecting 110 RMB. So we just add 2 versions of the same formula together. In this case, we use a 1 for the exponent, and in this case, we use a 2. So this 100 in a year is worth 89 now. 110 coming in 2 years is worth 88, almost the same. Add them together, 177 RMB. So 177 RMB equals those 2 expected cash flows. You'd basically be indifferent if you were on board with this 12% discount rate. Now, one more thing to talk about while we're on the topic of formulas. What if we have a steady stream of cash flows growing at a steady rate forever? Okay, if we don't have that, by the way, we have to do it in the one-off, one-at-a-time way I just showed you. But if we've got a steady stream, we can value it as what we call in finance a perpetuity. The formula is called the Gordon growth model in English. You basically put the payment divided by the discount rate minus the growth rate. So hypothetically, if we had 100 RMB starting payment, it's going to grow at 2% per year. And in this case, we have a 10% discount rate. Why not 12%? I don't know. We just picked 10% for this example. Okay? But if you use these numbers, 100 divided by 10% minus 2% equals 1,250 RMB. In other words, you'd be indifferent between getting 1,250 RMB as a one-time payment or getting this steady, slow growth, 2% grower that starts at 100 RMB and goes on forever. That's the Gordon growth model. Now let's put all these things together and value an actual, well, not an actual, let's value a hypothetical company, but a specific example using numbers just like we'd find in real life. So let's assume these are the numbers. Okay, so cash flow the prior year, 100 RMB. Growth the next 5 years. Annual growth is 10% per year. Growth years 6 through 10, 5% per year. And year 11 and after, perpetual growth at 2.5% annually. We chose this number because eventually all companies end up growing at a growth rate that's roughly the global growth average. All right, otherwise they would just grow massively enormous. Now, they might end up growing after 10 years at this average. They may end up growing after 100 years at this average. Some companies grow for decades at much higher than this. Very few. Most companies mean revert much sooner. But eventually, for mathematical purposes, we have to assume some convergence to this mean. Otherwise, the company would just literally grow into the entire global economy. All right, cash per share, cash for the whole company is 50 RMB. It's a small company. Debt, the market value of debt, 75 RMB. Let's assume a 10% discount rate, and let's assume 10 shares outstanding. So very simple numbers. Here's how we would put this together to do a real valuation. Okay, so again, let's remember the formula. Payment over 1 plus the discount rate to the number of years. We're just going to use this for our first segment. These are the cash flows before it gets to terminal growth. So the blue number is the nominal. Okay, these are the actual amounts we expect this company to earn. Remember, it started at 100 before we got started. So the next year, it's growing at 10% for the first 5 years, 10% annually. It grows a little bit more, and then we got a little bit above 200 RMB per year by the time we get to the end. Now the value of these numbers altogether, which we care about, by the way, is the red. The red is the present value. The blue is the future value. But because we're doing discounted cash flow valuation, which is basically present value analysis, we care about the red. So in other words, these 200 RMB cash flows are worth just under 100 in present value terms because they're so far into the future. We add up all the reds and we get 936 RMB. Are we done yet? No, we're about halfway done. We haven't done terminal value yet. So for terminal value, remember we did the first 10 years, we'll go to year 11. We say, all right, 211 RMB. That's what I'm going to earn, or what I expect the company to earn then. First thing I do is I plug that into the Gordon growth model, and I say, all right, well, cash flow growing at 2.5% with a 10% discount rate is worth 2,813 yuan. We're not done yet. We have to discount that. That's worth 2,813 yuan here. But what's that worth in today's dollars? Well, we stick that in year 10 and find out that it's worth 1,085 RMB. So in this case, we've got about half of the company value coming from the cash flows before it reaches that terminal growth, and about half coming from terminal growth and thereafter. Now I did have a little question here. Why year 10 if the cash flow is coming in year 11? Well, remember that investors are forward looking. So you could think of it like this. You hold through all these years, and then once it's finally about to reach that steady state growth, you sell this company. You sell it to somebody who's using that Gordon growth model, and he or she is looking at year 11 as the first cash flow, but paying you the money in the end of year 10. All right, so you're looking ahead a little bit, but you're actually discounting it as if it came at the end of year 10. All right, let's put this all together and see the result. So we take the 936 that we got as the value pre-terminal cash flows. We add 1,085 terminal cash flow and thereafter, and we get 2,021 RMB. Getting closer to done. Add 50 in cash, take out 75 in debt, and we get 1996 yuan. Next, we divide by 10 shares outstanding, and we get 199.6 as our estimated value per share. I said estimated because if the stock is 199.5 RMB today, would you buy it? No, what you shouldn't. You shouldn't, because this estimate is barely over that. You need to leave a little cushion. We call it margin of safety, because this is just an estimate. How much margin of safety? Well, it depends. It depends on you, your risk tolerance, and on the riskiness of the company. For a very safe company, you might be okay with a little bit less. Maybe a little bit more than 10% is about the lowest I think most people would go. For a risky company, you might want 40 or 50% margin of safety. So there's no hard rule, but generally speaking, the more risk, the higher the margin of safety. All right, let's wrap up with a quick quiz. Number one, what kind of company is best for price to book multiple valuation? Well, you should know this by now. It's financial companies because of mark-to-market accounting. Second question, how do you handle issuance of future shares in discounted cash flow valuation? That's kind of a trick question. And I think a lot of professional analysts get this wrong too. People think, oh, a company issued more shares. That's dilution. That's bad. Just like cutting a pizza into more pieces. But actually it's not, okay? Here's why. If a company issues shares at a fair market price, they're receiving cash for those shares. So earnings per share is being diluted, but value per share is not. Company sells a stock for 100 RMB. Yes, they dilute their investors by that in a kind of a business earnings sense, but they increase the value of the company by 100 RMB offsettingly by taking in that cash. So I do nothing to adjust for future share issuance. It does not affect the valuation. What does is issuance, exercising of management stock options for lower than the price, the current stock price. For example, if a manager joins, the stock's at 20 RMB, and she gets a bunch of stock options at 20 RMB. Then later on the stock goes to 100. She has the right to exercise those 20 RMB options and buy a stock that's now worth 100. So she gives the company 20 in cash and gets something worth 100. That's 80 RMB of dilution per option. Okay, that's the only true dilution, not selling shares on the open market. So that's one of the big things that people get wrong. Now, last thing here, how to handle a permanently increasing terminal growth rate. Instead of 2.5% forever, for example, what if it's always growing a little bit? Well, that's a trick question. Yeah, I'm sneaky. Trick question because, first of all, you couldn't use the Gordon growth model if the growth rate is increasing ongoingly in the first place. It wouldn't be a steady state growth. But second thing, and even more important, is that a company just couldn't do that. It could not grow forever. All trees eventually stop growing. Nothing grows to the sky. All right, so it would just become the entire economy of a state, of a country, or a region. So you're always going to have a terminal growth rate. The question is, does it happen in year 5, year 10, year 50, year 100, year 120? Nobody knows, but that's what makes investing potentially profitable, is putting your views up against someone else's and being right. All right, you've watched this far, and we're thankful that you stayed with us. We hope you learned a bunch, and we always enjoy being here and sharing what we know with you guys. So let's recap in specific terms what we'd like you to take away from this class. First and most important thing, stocks, we believe, are the best investment for the long run. Second thing, we also believe fundamental analysis is how most of the big money has invested in the market and made money. It's the one most supported by academic evidence and, frankly, anecdotal evidence. It's better for an economy, and I believe it's better for you as an investor too. Speaking of you, when you're finding your stocks, first find your factors. Everything else will fall into place. You can use return on assets, return on equity, and return on invested capital to show the quality of a business. Multiples are not really the best way to value companies, but they're just too easy not to use. So use them, but know their weaknesses. DCF, or discounted cash flow analysis, is definitely more precise, more professional, but it's going to take some time. It might take an hour or so to do a reasonably, even a moderately quick DCF. It could take a lot longer if you really want to go crazy with detail, but it requires time commitment. So pick your battles, we'd say in English, with that. Don't do it for every company. And as a bonus, I'll throw in, you can use low-cost index ETFs to get started, and then add stocks on top of those. This will get you diversified already. There's nothing sadder than watching a new investor run out and buy some super risky stock, and then it crashes. And he or she is like permanently scarred and scared of investing forever. We don't want that to be you, okay? So protect yourself either with index ETFs or save stocks to get started, then add the riskier stuff, just like the sugary dessert on top of your healthy dinner based on broccoli and lean meat, all right? So hope this class helped. We thank you. Thank you for joining us here. And if you'd like more courses, just let us know. We're happy to make them for you. So on behalf of Lulu here,
感谢收看本次课程。如果你们喜欢本次课程或者有任何的问题的话，也欢迎留言给我们，以及欢迎把本次课程转发给你认为同样需要了解这些投资基础知识的小伙伴们哦。如果你有任何问题，都欢迎转发留言。感谢大家收看。
谢谢，谢谢。